Hello guys, so welcome to the second day of your training with ForexKits Academy. This is the day 2 of the basic class, okay? And then we are going to go straight into Forex trading terminologies. These are some of the words you are going to hear, in your journey as a trader. Maybe during your interaction with other traders, maybe during the classes. It's really important. These are not everything, but then you learn some other things as you go, okay? But these are the ones that are really important from you going onwards, okay? So the rest will just come, with experience and usage, okay? So what's the first thing? Long. So you could hear a trader say, I'm long on this pair, or I'm going long on this particular pair. What that means is that they are buying that particular currency pair, okay? The reverse is, this short. So if someone says I'm shorting this pair, or I'm short on this pair, that means that they are selling that particular currency pair. Okay, so let's just show you what a real chart looks like. So if I pull this up, okay, this is how the chart looks like, okay. You have candlesticks showing up here on your chart, showing you every single thing being represented here is price data, okay, how price has moved in a certain period, okay. So if I go here, I can change this to lines. If you take a close look, you see that from this point down here, so from this point down here to where we are currently seated right now, which is here, okay, that price has been moving higher. Then if you can look closely, you see that where we are currently, there are fluctuations. There is a beep at that point, so changes are happening at that particular point, which just reflects the fluctuations in price. So of course you can decide to show your chart however you want them. You can decide to use bars as well, to represent. All of this is just ways to represent price data. But then, if you look to your right hand side, you are going to see price quotations to your right hand side. Okay, so the exchange rate, right? Okay, so you see something like 1.3800 and 1.3760. All of this is the exact exchange rate for this particular currency pair. So if you look closely, you see that this is GBP USD. Okay, yeah, so this is GBP USD. So GBP USD. Okay, and then understand that all the price that is quoted to your right hand side here, okay, this is the USD value of the Great British Pound. So to purchase, following where price currently is at this point, right? If you look to your right hand side, you see 1.37886. so let me write that out. 1.37886. okay. A lot later you learn that this last digit is not really important to you. These are the only digits that are important to you, but then this is just to show you how this foreign exchange works and what you do. So if you believe that at this particular point where we are right now, that USD is going to gain some strength, okay, and the GBP, okay, so the Great British Pound, right, is going to lose some strength, okay. So that means that the USD will overpower the USD. That means that you are expecting this chart to come down, okay, and that's when you get into a selling position. And an example of that, or the word that we use for that in the explanation, is to short. So if you are shorting a currency pair, you are selling. When you sell, you expect that price is going to come down, okay. Then if you believe that GBP is going to gain strength, okay, so GBP, which is the base currency, is going to gain strength, and the US dollar is going to weaken, okay. If the US dollar is going to weaken and GBP is going to gain strength, that means that you expect the chart to go up, okay. You expect to see an upward movement, okay, on your chart, and then that means that you get into a buy trade, and eventually if it goes up, you profit from that particular trade, okay. So to make this easier for you to understand, let me leave this window and go higher, okay. So yeah, so take a close look now. So yeah, so let's take, for instance, this is Naira, okay. So let's say the pair that we are trading, okay, is USD NGN, so Nigerian Naira, okay. So forgive my handwritings, but then you have price quoted just like it is here, but in Naira it's going to be something like 150, okay. So 150, 200, 250, 300, okay, 350, okay. And this is where price currently is at, okay, at 150, okay. So let's say below here we have 100, we have 50, and we have 0.00, okay. So all of these are the different price levels, okay, just like the prices you have quoted to your right hand here on your trading platform, okay. And then remember that TradingView is a charting software. The price data that we have is being sent to us by a broker, so we can be able to assess the foreign exchange market and understand the changes that are happening in price, okay. So now that we are here, what do we, what information can we derive from here? So if price is here at 150, okay, and then you believe that the US dollar is going to perform better than the naira, so that means that the naira is going to weaken, okay, and the US dollar is going to do what? Gain strength, okay. If this is what you believe, and then you have a target that price is going to go from 150 to 300, all you do is what? Place a buy trade. And once you place a buy trade at this point, okay, so you place a buy trade at this point and price starts moving upwards, you've started going into profit. And then look at what happens. Price leaves 150 and is currently at 200, okay, and then we'll go to 250 and eventually we'll reach your target of 300, okay. So by the time it is there, that means that 1 USD, okay, will now be equal to what? 300 naira, okay. 1 USD will now be equal to 300 naira, okay. So that's just how it works in foreign exchange as well. If you expect that naira is going to gain strength, okay, so sorry about that. If you expect that naira is going to gain strength, okay, if naira is going to gain strength in your own opinion, then that means that you are going to go into a sell trade, and then your target will be something below that level. Your target might now be 50, okay. So you expect that price is going to leave 150 and come down to 50. In that particular case, what are you doing? You are selling, okay. So in this particular case, this is what we meant by shorting a currency. So when we say that you are shorting a currency, this is an example. When we say that you are long, okay, so you are long, that means that you are buying that particular currency pair. And what do you expect for long scenarios? You're expecting that price is going to go up, okay. So now that you understand when to go long and when to go short, then we'll move on to the next one: bullish and bearish. So basically, bullish is an indication of an upward price movement. So when price is moving upwards, we say that is a bullish movement. When price is moving downwards, we call that bearish, okay. So bearish movement when price is moving downwards, and bullish when it's moving upwards, okay. And then you can hear some traders also say something like bears and bulls. So bulls are people that are buying, bears are people that are selling. So back to our charts, okay. So let's try to see an example. So clear example. Take a close look at this level right here. Price was moving higher, okay. So at this point we can call this what? A bullish movement, okay. So bullish movement. Then if we go higher, or maybe look to our left hand side and try to see, perfect example. So this is an example of a bearish movement, okay. So because price is doing what? Moving downwards. You look at the candlestick formations, we are making pushes downwards. So this now makes this what? A bearish movement, and then move upwards is a bullish movement. And then the people that participated in sell trades at this particular point are called what? The bears, okay. So they are trying to push price down, they are filling in sell orders in the market, so they are called the bears, okay. And then the people that are doing was the people that are buying at this point, where we had this bullish movement, or anywhere that you have bullish movements, right? An example is this point right here. So we're moving higher. So the people that are buying are called what? The bulls, okay. So if we are bullish, or we are, if we are bullish, we are buying, or we are going into a long trade, we are bulls. And if we are selling, it's the reverse, we are bears, and it's a bearish movement, okay. So on to the next one. Margin. We'll have a really in-depth study on margins in a short while, but basically all you have to understand that margin is the deposit required to open or maintain a position in the foreign exchange market. So when you are getting into a trade, money is being required for you to be able to execute a particular trade, right? A certain amount is being taken out to execute a particular trade for you, depending on the volume that you want. And then once that is taken out, that's your margin, okay. So we have free and used margin. Used margin basically refers to the margin that you've already used to get into a trade, and then free margin is the one available for you to use. So more on that later, but then this just makes you understand that you need to have money in your account in order to make profit from the foreign exchange market, okay. So money has to be taken out a little bit and just kept in there for you to be able to execute a particular trade. And then balance refers just like regular every other thing you do in life. Balance basically refers to the amount, the capital that you have to be able to get into a trade while no trade is running. So what is your full capital? What is the full amount, or the total amounts that you have in your trading account? While equity is a result of your balance plus the current result of your trades that are running. So if you have trades that are running into profit, it will be added to your balance, and that will now be your equity. You know, even if that has not been added to your balance completely because you've not closed that trade, it just gives you the real-time calculation of what your balance is worth at that particular time, or what your account is worth. And then as soon as you close it, it goes into your balance book. As long as the trades are still running, whether it's running in a profit or it's running in a loss, that is now called equity. So the result of that, you know, your balance, the result of your balance and what is happening to your trades at the point in time, whether it's in profit or whether it's in a loss, is what's equity. But then